Hi, my name is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your April 2020 market update. Well, the coronavirus outbreak is causing tremendous human and economic hardship across the United States and around the world. The virus and the measures taken to protect public health are inducing sharp declines in economic activity and a surge in job losses. Gross domestic product, which is a measure of a nation's economic activity, fell 4.8% in the first quarter of 2020, according to recently released numbers. And that really provides us with the first detailed glimpse into the deep damage the coronavirus has wreaked on the U.S. economy. Now, most economists see the U.S. in recession already, even though the technical definition is generally 2 consecutive quarters of negative growth. And the fourth quarter of 2019, as you can see on this chart, we saw GDP rise 2.1%. But we're still saying that we're in a recession now because the view is that the first quarter numbers only include a first week of the economic shutdown brought on by the coronavirus, and even that probably underestimated the real damage. The Bureau of Economic Analysis, which releases the GDP numbers, itself pointed out in this note, which I have at the bottom of the slide here, that the coronavirus lockdown led to rapid changes in demand as businesses and schools switched to remote work or canceled operations, and consumers canceled, restricted, or redirected their spending. The full economic effects of the COVID-19 pandemic cannot be quantified in the GDP estimate for the first quarter. So we're not quite sure how much GDP will decline, but it does look like we are in a recession. But just given estimates of what else we've seen come in, this is what we are actually expecting for the second quarter. The expectation is that first quarter GDP will be revised lower, and that second quarter GDP will be a contraction of somewhere between 25 and 30%, a once unimaginable figure. Second quarter numbers will be significantly lower because in the US, most of the stay-at-home orders were not enacted until mid-March. So just for comparison purposes there, the gray area shows you the last recession we had, the Great Recession of 2007, 2008 time period. So this is expected to be much worse in magnitude. However, it's a completely different type of crisis. And so how long it takes us to recover from that depends on very different things than what we were looking at in 2007, 2008 type environment. Now, consumer spending accounts for about 70% of gross domestic product in the US. So how quickly we actually do get back to work and start spending again will be the determinant of how quickly we recover from the sudden slowdown. So the GDP numbers that have come in and that we're expecting do not look good, but the market has rallied on a combination of hopes for a smooth reopening, expanded testing capabilities, and treatment advances. We also had a lot of fiscal and monetary stimulus and low interest rates. So through April 30th, the market had recovered about 61.8% of its losses, which is shown by those yellow bars there. That shows a Fibonacci retracement. So it shows how far it dropped initially and then how much of that drop we've recovered. So we're seeing almost a V-shaped recovery in the stock market here, but yet we do not expect a V-shaped recovery in the economy. And that has been one of the most stunning things about the month of April is just the speed and the velocity of the market recovery, which has us wondering, will this hold? So before we get to that point, let's show you what this looks like in numbers now, year to date. So through the end of April, the S&P 500 had recovered, as I said, about 62% of its losses to end April down only 9.29% on the year. Domestic small cap stocks, the red bar there, were down 21.08%. International developed stocks were down 17.84, emerging markets 16.6. Commodity index was down 24.47 and really got hit in this past month due to plunging oil prices. And then the Barclays Aggregate Bond Index, which is a measure of investment grade fixed income returns, have been up 4.98% for the year. So the interesting thing about this advance is when you look at this and how quickly the market, as measured by the S&P 500, has recovered, the really interesting thing about this is just kind of looking behind the hood. The performance of the S&P 500, in my opinion, makes the stock market recovery look better than it's actually been. And a lot of this has to do with the FANGM stocks. This is the new but very clumsy acronym. for 6 of the largest companies in the US. So it includes Facebook, Amazon, Apple, Netflix, Google, and Microsoft. And these 6 companies dominate the S&P 500 index. And the S&P 500 index is the index that's most often quoted on the news, this in the Dow Jones Industrial Average. And because it's market capitalization weighted, that means that the largest companies contribute the most to performance. So even though the S&P 500 is a performance of the 500 largest companies in the US, just 6 of them, the 6 I showed you here, account for 23% or almost a quarter of the index's returns. And it's important to note this because over time, the S&P 500 has become less representative of how the typical stock is actually performing. So I wanted to break this down for you another way. We can look at this another way by saying, well, instead of market capitalization weighting it, meaning giving the most performance contribution from the biggest companies in the country, why don't we equal weight them so that every company within the index has an equal voice in terms of its performance? And what you can see here is year to date, if you were simply to take the S&P 500 index and equal weight it, so instead of giving most of that weight, a quarter of the weight to those just 6 companies I just named, equal weight across all of the 500 companies, that index is still down 16.11% year to date. And over a trailing 1-year period, the S&P 500 is up 0.86. But again, if you were to give equal voice to all of the companies that comprise the index, it's down 8.92% over the trailing 1 year. And additionally, those FANG stocks that I quoted, those are also in the sectors that have been the best performing sectors this year. So here's a chart of year-to-date sector performance. This is actually through May 1st. What you can see here is that technology, healthcare, and consumer staples have really led this rally, whereas sectors such as materials, industrials, financials, and energy stocks have very much lagged. And so one of the things I wanted to remind you of as a values-based investor is that sometimes it's very easy to get caught up in what the market as a whole is doing, meaning the S&P 500, and seeing what the performance is of that index on a daily basis. And it's easy to become disconnected from what you're actually investing in. It's really important to remember that when you invest in the market, whether that is through individual stocks or ETFs or mutual funds, you're actually investing in individual businesses. And because of that, when you invest in a company, you legally become part owner of that company, and you want that company to succeed and thrive. You want that company to attract more customers and to sell more of its products. And so as a faith-driven investor, it's important to know, well, what are you profiting from if you are in fact part owner of a company? And one of the unfortunate side effects of the shutdown, there have been many, many unfortunate side effects, but one of the things I wanted to zone in on here has been an increase in how companies are preying on human addictions throughout this particular market cycle. So while many Americans are coping with the fear and uncertainty of the virus pandemic, the pornography industry has stepped up and responded by providing free access to content. And this is an offer that's drawn harsh criticism from leaders of the fight against sexual exploitation. So just to give you some statistics on the increase in pornography use since the shutdown, this one is from India. The demand for pornography has skyrocketed worldwide, but this one from India I found to be quite startling. In India, consumption of child pornography since the lockdown began on March 23rd has skyrocketed by as much as 95%. The internet in India is gradually becoming extremely unsafe for children. Millions of pedophiles are allegedly now online and consuming more and more child pornography every day, and there is a large issue in relation to child sexual exploitation in India, which is why I bring that up. And in the parts of the developed world, it's not any better. So traffic to the world's largest pornography site increased by 57% in Italy, 38% in France, and 61% in Spain, after free memberships were launched to combat boredom from the lockdown. So by mid-March, worldwide traffic to the world's largest pornography website was up 26.4%. Now, I spoke just a few slides ago about how 6 companies have been leading the performance of the S&P 500 index. And just one thing to point out here is, did you know that 4 of those FANGM companies that I spoke about earlier are involved in the distribution of pornographic content. And 3 of them are listed as one of the top 12 contributors to sexual exploitation by the National Center on Sexual Exploitation. So we as a company, because we do values-based investing, we don't want to profit from these types of companies. And so every now and then, whenever those companies are the ones that are really leading the market rally, you could see a slight drag in your performance versus the broad index. But again, it's because we only want to invest in and profit from those companies that are in alignment with our values. And studies show that the performance lag is usually fairly short-term in nature. So just one other area to look at is alcohol. So alcohol consumption has increased due to the shutdown. And remember that when it comes to alcohol, one of the reasons why we don't invest in it is that the top 10% of drinkers account for well over half of the alcohol consumed in a given year. So when you invest in alcohol, over half of your profits are coming from those who are addicted or coming from alcoholism. So from this shutdown, what we've seen, there's a lot of studies out, or news reports rather, out now showing that consumers are very much shifting their behavior because of the stay-at-home orders from drinking alcohol occasionally outside of the home to drinking on a more regular basis inside of the home. One poll found that 1 in 5 households reported buying more alcohol. 1/3 of those households are now using alcohol daily, and 28% of those reported that they are drinking alcohol on a regular basis to cope with anxiety and stress. And this is concerning because alcohol is correlated to an increase in many other issues in our society. So numerous reports have come out citing a substantial increase in domestic violence since the stay-at-home orders were put into effect. And studies also show, one study from the Journal of American Medical Association said that 92% of domestic abusers are abusing alcohol at the time of a domestic incident. And so we have seen an uptick in domestic violence since your shutdown as well. So we're having a lot of repercussions from the pandemic, not only economically and also physically with health and mental health issues, but also a lot of companies now just going out and preying on those human addictions and trying to profit from them at a really difficult point in time for society. And this is something where society will likely be affected in a negative way for many years to come. And so if you're a client of Beacon Wealth, you can rest assured that we continue to exclude companies involved in negative business activities, and we continue to identify those companies that create a positive value and blessing in the world in terms of including those companies in our portfolios. So one of the questions you might have is, well, we've had this nice rally since the lows of March. Are we now out of the woods? Well, I mean, there have been a few positive signs that have come out. So we've had a flattening of the curve, some new therapies have come out. There's been an enormous response of the government and the Federal Reserve to prop up the economy, which has helped stage this market rally very much. So I don't want to discount those items, especially how much the government has stepped in to prop up the economy in this very difficult time, especially with high unemployment. However, I do think that the market has gotten a little ahead of itself. To recap, this rally has been concentrated in just a few sectors, namely the technology and healthcare industries. A lot of the rally has been led by just a few companies, and mostly those companies that I named, the FANGM stocks. They're the reason for a lot of the performance so far this year. And so if you look under the hood, while the S&P 500 may have recovered a lot of the losses this year, when you're looking under the hood at how broad-based the recovery is and how many companies are actually leading the market higher, the market's still exhibiting some signs of weakness. So it's good that many states are, well, possibly good from an economic perspective, maybe not from a public health perspective, but from an economic perspective, it may be good that states are opening up their economies again, but the economy doesn't just restart with a push of a button. You can stop it with a push of a button with stay-at-home orders, but it's very difficult to get it going again. A second wave of reinfections is possible that could cause states to close once again. So that's probably the biggest thing on the horizon that could happen, that could put a pause in the market rally. But also there's this fear of contagion. So US household spending has driven much of the economic recovery of the last 10 years. And so a shift in sentiment could result in reduced spending and delays of big ticket items such as homes and automobiles. And my thought, at least, is that people are probably not going to be flocking to bars, restaurants, movie theaters, getting on airlines, traveling, even after these states start to reopen, because there's still this fear of contagion, which is likely to keep many people home for a while. And so, because of these reasons, I don't think we're out of the woods yet. I think the market has gotten a little bit ahead of itself, but we're hopeful that as healthcare companies continue to find possible treatments and professionals continue to work on possible vaccinations, that hopefully the downturn will be short-lived, but there are still many things that could go wrong. And so I don't think that we are completely out of the woods yet. And for those reasons, how we are positioning portfolios is that we are maintaining our discipline of investing based on our future expectations, not based on the fear of missing out. So when you have a large bear market rally like we've had over the last few weeks, it's very easy to have a lot of angst about whether or not you missed out. If you're too late, you try to just get on the bandwagon and jump on, and that's one of the worst things you can do. We maintain our discipline of investing based on future expectations and not based on very short-term moves in the market. So we're maintaining that discipline throughout the cycle. We're also maintaining a focus on high quality companies that are likely to be resilient, those that have a lot of cash on their balance sheets, that are likely to come out of the other side of this recession. We are maintaining a higher than normal cash position for clients, both for liquidity purposes for our clients and also to capitalize on opportunities in the market. And finally, we will continue to rebalance portfolios opportunistically. Our last rebalance occurred actually one trading day before the market hit the bottom on March 23rd, which has worked out wonderfully for our clients. We're able to sell out of some bond positions that had increased in value and bought into the stock positions that were deeply sold off at that point. And so maintaining that rebalancing discipline throughout the cycle can also add to risk-adjusted returns for our clients. We hope that you're doing well and that your family is safe. And as always, please reach out to us with any questions that you may have.